A very good evening to everyone. I'm Crystal, the Community Manager at ProsperUs, your host for tonight. Thank you for joining us on Thirsty for Stocks, Understanding Businesses. I've been in the financial industry for over 5 years and is currently focusing on building the ProsperUs brand among the younger millennials who are still very new to investing. You'll be seeing me more often in upcoming webinars. So let me introduce our speakers for tonight. We have Tim. I'm pretty sure some of you are very familiar with him. He's our content composer with over 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. Tim believes that successful long-term investing is within everyone's reach. Up next, we have Casey, who has been in the investment industry for more than 5 years and is currently an equity research analyst based in CGS-CIMB, Singapore. He was also voted the best analyst in Singapore for materials at the Asia Money Brokers Poll 2020. So, what is ProsperUs? ProsperUs is a digital investment platform where it was recently launched in this March that is catered for the millennials by the millennials. As you know, being a millennial myself, we love to get things done fast. And yes, you can expect this standard from ProsperUs. We have improved our account opening process where your application via My Info will be approved on the same business day. And as part of our educational efforts, we have specially curated series like our webinars for millennials to gain more insights on investing. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. If you want to have a feel of how our digital platform works, do hit us up for a demo account. And to cater for your investing convenience, we have recently launched the ProsperUs mobile app. So do head over to Google Play or the Apple Store to download it today. Last but not least, follow us on social media like Instagram or Telegram to keep yourselves updated on the latest news. So without further ado, I'll hand over to Tim to start today's session. Tim, over to you.
Hi, thanks, Crystal. Hey, everybody. So again, like as Crystal was saying, thirsty for stocks, understanding businesses. So I think we've got a lot of feedback about, businesses and stocks, and there's behavior towards investing, but people actually really want to understand how to actually pick a good stock, or how to pick an investment, or how to pick a general sector that you want to be invested in, because I think longer term that obviously matters where you're invested, especially if you are picking stocks. If you're in an ETF, it's probably less relevant, or if you're in a fund, it's probably less relevant because you're delegating that responsibility to an index or to a fund manager. So without further ado, let me kind of just share my slides here first. Here we go. Yeah. Okay, just move this across. Yeah, so I'll go through the obligatory disclosures and disclaimers. This is obviously not personalized financial advice. This is my own personal opinion. So, do your due diligence, of course, if you are looking to invest, and whatever you're investing in, properly research it as well and go into depth, into it. Okay, so I think before we start, I kind of just want to clarify and I guess ascertain what an actual stock is, right? So I mean, when we buy stocks, a lot of people tend to view them as just these tickers on the screen and lots of numbers and green and red, and it's going up, it's going down, and it's very emotional when you look at the amount that maybe it goes up in a day or even in a week or a month. But actually we should be looking at the actual business itself, because obviously these stocks, they all generate money. They're all actually businesses. So when you buy a stock, you're actually becoming a business owner in a sense, but obviously a very, very small percentage business owner. But you are essentially a business owner. So you own part of an actual business that is creating money, that is creating value, that is creating products. So such as Apple, right? So I mean, these businesses are actually making things that people either are subscribing to or buying watching or consuming on a daily basis. So before we kind of delve into looking out for what we should find in a business that is desirable, I think we should just acknowledge the fact first that these are actual businesses and that we are invested in them in terms of like the actual business, wanting it to do well over time. So it's not really just a number or a ticker. So I think once we get over that hurdle, we can kind of be a bit more comfortable with being interested in how the business is doing and maybe paying less attention to the share price on a daily basis, because the share price a lot of the time, or most of the time, if it does go down or if it dips or goes up, it doesn't necessarily reflect the actual business and how the business is doing. So that's something I just want to put out there before we kind of delve in. And they've got cash flows, right? So these businesses, they generate a lot of money. So this, for example, is PayPal, which generated about 23 billion, 22 billion in revenue, and about 5 billion of that was free cash flow, right? So free cash flow is a measure basically showing how much cash you have left over after expenses and capex. So I won't bore you with the specifics, but it basically means how much cash you have left over to distribute to either to investors or to reinvest into the business after all your expenses are taken into account, or your operating expenses and capex are taken into account. Okay, so I'm going to start by going through growth stocks first, because obviously this is a really broad section in terms of what to look for, metrics wise, specifically for either, I don't know, e-commerce, or if you're looking for a dividend stock. So I'm going to go for broad growth first, and then I'm going to go with broad, like sort of dividend and what you kind of want to look for with dividend. So I'm going to try and shoot through this and then hopefully not bore you too much, and then we can get into questions and answers at the end. After obviously Casey's bit, I'll pass on to Casey after this. Okay, so I'm going to take a look at growth stocks. So growth stocks is obviously stuff that is growing really fast, right? So the first thing you want to look at in terms of in terms of a growth stock, or what we would term a growth stock, is essentially the top line, right? So the top line of the this financial statement is sales growth, is revenue, right? That's what you want to see. You want to see it accelerate at a good pace. So this, for example, on the right is Amazon's latest quarter. You can kind of see net sales there, which is also revenue, increased 44%. So when you do see companies announce figures like 44% or 55%, it's basically referring to the percentage over a year over year. So if they recorded 44%, that is 44% gain compared to the first quarter in 2020. So effectively, it's a year over year comparison. So you can see there with Amazon, a business their size already big, it's grown 44% in its latest quarter year on year, right? So it gives you a good idea of the company's ability to drive growth. That's first off, because obviously if the company is not really growing very fast, that means there's something obviously wrong with the model, or they're not really attracting enough attention and not really attracting enough consumers to their product, right? So what's a normal range, in terms of revenue for growth? I'd say anything like above 25, 30%, you could kind of consider growthy, especially in the US. I mean, some of these companies, you're looking at Amazon and even Microsoft, they're growing at 30 to 40% a year, and they're very, very big businesses, right? So you would say that they're really secure businesses. They're very solid cash generative businesses, but they're still growing in a very, very big way as well, because obviously they've got a lot of different levers to pull to grow their businesses. And you obviously have to understand, how does that interact with say R&D and marketing and stock options, because a lot of companies that are maybe a bit smaller in the tech space, they go public, they pay a lot of their remuneration in stock, and so that comes down as a cost, right? And so that can impact results as well. So that's something to be wary of when you are looking at revenue, sales growth in comparison to other metrics within the company as well. Okay, so I'm going to move on to gross margin. So I think this one's really important for tech stocks specifically, and growth, because when you look at gross margin, it's looking at the revenue minus the cost of goods sold, right? So it's basically the margin that a company takes after they subtract the cost of goods sold. So what you're kind of seeing is that a lot of the software companies, or cloud stocks, as we would like to say, they have really high gross margins, right? So if you're like a manufacturing company, or if you're maybe a tech manufacturer, your margins are going to be sort of lower, because you're obviously making things you're making like real tangible things, right? So every time you say make a widget, the extra dollar in terms of cost going in to make that, it rises exponentially in terms of actually having to produce that widget. So gross margins in software and in cloud, in terms of tech stocks, they can have gross margins up to sort of 80% at times, which is quite amazing. So what that means is that basically, maybe, the example there is, 80% of every dollar that they generate, they get to keep in terms of gross profit, right? Which is unbelievable. And so eventually that will flow down to a net profit if they can scale. So that's the one thing about tech stocks that I think you have to look at specifically, is the gross margin, and is that trending up for growth stocks? If there's a trend that the margin's going up for the gross margin, that's a good trend to look out for, especially when you're looking at growth stocks. Okay, this one's really important for growth, just because this isn't actually specific to tech. This is just anything, I would say. You basically want a growing total addressable market, which is termed a TAM. So does the company operate in a large total addressable market? Does it give the company enough of a runway to grow their revenues, and then obviously grow their profits after that as well? Because obviously if you're growing at 40, 50, 60, 70%, there are going to be expectations in the market that you're going to be able to do that probably for, however many years forward. So for growth stocks, they definitely need to have a total addressable market that is big enough for them to tackle and for them to kind of grow into. And is it one that can keep growing over the long term, right? Is it one that is structural in nature? So structural, we kind of think of as maybe like an e-commerce, which, isn't going away. That's definitely going to keep growing, right? Or is it a cyclical thing where it's maybe oil demand? So cyclical, you think oil demand goes up, I don't know, for a specific period, when more oil is in demand for, maybe the summer, and then maybe in the winter, and then maybe it goes down again later. So it's all dependent on whether you think it's structural or cyclical. And obviously with growth stocks, we want the TAMs, and we want those types of companies to be structural. You want there to be growth for the foreseeable future, right? For 10, 15, 20 years. You don't really want growth for like a year and then growth to taper off and then for it to go down again. So it's really consistent growth and strong growth over time. That's what you're kind of looking for. I'd say something else that's a bit more of maybe a soft skill in the TAM market is, are they the first mover in that market? That's really important, especially in tech, because if they can kind of build up that base, or that consumer base, and that network effect, that kind of sort of snowballs itself, and then they kind of get more customers, more revenue, and the TAM kind of grows out as well. And finally, I'd say optionality. So I'd say you see optionality as something as growing the TAM. Can they keep growing their total addressable market? So for example, on the right, we have cloud security here, this is a CrowdStrike presentation. And you're looking at CrowdStrike, at the moment, IDC estimates that only about $1.2 billion is spent on hybrid cloud. And so that's about 1.1%, right, of I'd say like cloud IT spend. And what IDC recommends is that companies have to spend at least 5 to 10% of their IT budgets on security. And obviously there's a massive shortfall. So there's a massive gap in spending what companies should spend. And obviously, CrowdStrike, being a cybersecurity company, is going to want to take advantage of this. So this growth runway, or this market that they see, is definitely big, right? And so I think it's dependent on whether you have faith in management and what they believe, and if you have faith in the structural story. For cybersecurity, it seems like that would make sense, right? With everything going online, all the data that's coming online, all the attacks that you're seeing, like ransomware, and it's basically a liability for companies everywhere. You don't even have to be tech, right? It can just be any company, anywhere that has any online presence, which is basically everybody now. So It's one of those that you think, can the market keep growing? Can it get bigger? Are there going to be offshoots for maybe them to make money somewhere else in the cloud space, in security in another area? So that's something to keep in mind as well. And the optionality part you can see in like an Amazon, right? They used to be just e-commerce, and then now suddenly they're a cloud computing provider. So they spun off and did something completely different and grew their market exponentially. So I think these are the types of things you want to kind of see with companies to see whether they have that potential. And then finally, I'm going to put dollar-based net retention. So this is basically a metric to measure how much money a company would make if they basically didn't take on any new customers, right? So for example, this is DocuSign. So they had a net dollar retention rate of 125%. So say they didn't take on any new customers and they just continued on with the customers they had, they would have made 25% more money from those same customers. So what you want, especially in tech, especially in cloud, is you want a high solid sort of net dollar retention rate. You want something in the but ideally above 120. That is good. And you can see them go up to sort of 130, 140. So that's stuff that you should definitely check out as well, because that kind of gives you an idea of the stickiness of the product, the stickiness of the tech ecosystem that they're kind of building, and whether customers basically like it. And if they like it, they're willing to pay for it. That means they're starting to spend more money with them as well. And so it kind of is like a virtuous cycle, I guess you could say. Okay, I'm going to move on to dividend stocks swiftly. So dividend stocks, we all know you need to have cash to pay dividends. So that's an important point. Cash flow is probably the most important thing that you need for dividends, I think, because cash flow gives you an idea of the amount of cash, as I said, the company has after minusing expenses. So if it has super strong cash flow, it has, healthy operating cash flow, then the likelihood is they can continue to pay the dividends for the foreseeable future. So cash flow is particularly one to watch, especially free cash flow when you're looking at the ability for companies to pay dividends. That's something that is super, super important. And then, has it got a track record of growth? I mean, that's something that we have talked about previously, or I've kind of touched on, right? It's great to see companies raise their dividends for a couple quarters, but if it goes down again for a couple quarters, there's really not much point. It's basically got to be going up consistently and to the right. So this is Maple Tree Industrial Trust, which I've covered before, but this has, an impressive track record. Besides, obviously, I think a dip in the COVID era, like last year, but I think that was something that was retained, and they obviously paid that out a bit. They paid out more of that this year, so it kind of made up for it. So when you're looking at dividend payments, you want to really look at consistency over long time periods. I think the longer the better. If you're looking at 5 years, go back 10, go back 15, if they have that record to kind of see, and just look at what they're paying each year. Has it grown? Has it grown consistently, or have they cut it? And why have they cut it if they have cut it? So I think that's really important, because when you're looking at income, you really want that security and reliability of the payments, that they're not going to get cut, right? Because obviously that's an important thing, especially if you're investing for either retirement or for income, or whatever. You kind of need that security and that reliability. And then finally, I'd say look at the payout ratio, right? So the payout ratio is the indicator that tells you how much of their earnings are they paying out in dividends. So this is an example. So Home Depot is a big American company. Their payout ratio has actually gone down over the past decade, but they've actually managed to raise their dividends significantly over that period. So it's actually a great sort of pair. You're kind of having a lower dividend payout ratio, but a higher dividend per share, which is great. So it's really easy. It's like not super hard to work out. You basically just divide the dividend per share by the earnings per share, and then you times it by 100, and then you'll get the percentage, which is the payout ratio, right? So it's basically the dividend per share, the DPS, as a percentage of the EPS, the earnings per share, and then you'll understand how much a company is paying out and whether that's sustainable. So the ideal indicator is, the ideal range would sort of be the like 40s to 50s, because that gives them room to kind of keep paying their dividend if maybe earnings drop a bit. But if you've got a company with a payout ratio of 90% or 95%, if earnings dip, then they're in trouble, or they're gonna have to borrow to pay a dividend, which you never really want to see happen. So I think with that, I will kind of end, but I kind of want to plug these upcoming sessions first. How best to pick mutual funds. We're going to be going through some really interesting ways to look at funds with our in-house fund expert, Jake. So check that out. That will be sort of the beginning of August. And then second, we've got a understanding risk and volatility in portfolios, which I think people tend to assume that risk and volatility are exactly the same thing, but in my personal opinion, they're actually different. So we'll be going through what that means for portfolios and how you can try and manage it a bit better going forward. So that's in late August. So yeah, that's it. I'll pass you on to KC now. So KC, please go
Okay, so
ahead.
before, sorry to
Oh,
cut
sorry.
you off.
Sorry. Yeah.
Maybe just before Casey starts, okay,
Hmm.
I have maybe just something for Tim. So
Yeah.
just out of curiosity, right? Do you have any advice on, say, the on the percentage of a portfolio should actually consist of stocks?
Hmm. I'd say like if you're under 40, I don't think you should have any bonds in your portfolio personally, because I just think bonds with yields being as low as they are, it's actually more dangerous to be in bonds than it is to be in stocks, even with stocks at the valuations they're at. And with yields that you're seeing so low, right? I think bonds are actually more dangerous long term. I think that's something that Seiboon, our chief investment strategist, has written about as well himself. I guess if you're over 40 or if you're nearing retirement, there might be obviously an argument to be in, I'd say, more like higher rated like bonds that are safer, but which are still yielding a decent yield. I don't know if you'll find that, but I think for anyone under 40, there's literally no point with bonds at this point. So I'd say, it depends on your age and your risk tolerance, but personally, and I think for most people who are younger, it really should be 100% stocks.
Okay, we have poll in progress. So let's take a look at the poll itself. Okay, so basically the audiences have majority of them have about 100% of their portfolio actually consists of stocks. So I believe this group of audiences are relatively young, I
Yeah.
hope, because for myself, right, I do not allocate that much percentage in stocks actually.
Okay.
I'm more of a, I wouldn't say I'm a risk adverse person, but relatively conservative. So I actually allocate my funds into other financial instruments as well.
Right.
So
I think this, I mean, I would assume this excludes like your cash and your
mm,
insurance and all that kind of thing. Cause like, I'm just thinking about investing from like a pure
correct.
investment perspective. Cause yeah, just to clarify, I don't think you should have like 100% of your assets in stocks at any one time. But yeah, that's interesting to see. Okay, cool.
Okay, so I think after your sharing, I think some of them might be reviewing their portfolio on the stocks that they have on hand. I
Yeah.
believe so. Yeah. So why not we actually move on to Casey for the second part of today's session. Casey, all yours?
Hi, good evening, everyone. I'm Casey, and today I'll be sharing a bit more on how do you analyze an industry. I guess following on to Tim's presentation, basically stocks are really made up of real businesses. So when you analyze an industry, you should also ask yourself the question, if I have the ability to start a company in this industry, would I do it? This would already likely in your mind filter out some of the industries because maybe you see it being too tough in terms of competitive landscape, or just maybe because the sector is being in a structurally declining trend. So today I'll just like to introduce two concepts or practice that one should adopt when looking to invest in a sector. First one is called Porter's 5 Forces, which is basically a framework that helps you analyze the level of competition within a certain industry. So the state of competition is basically dependent on 5 basic forces, which are on the slides here. So the collective strength of these forces determine the profit potential of an industry, and thus its attractiveness. If the forces are intense, then almost no one in the industry would earn a very attractive return on investment. Meanwhile, if the forces are milder, then there's a room for higher returns. So number one, let's look at competitive rivalry. So basically, this looks at the number and strength of competitors. How many rivals do you have? Who are they? How does the quality of the products and service compare with yours? So where the rivalry is intense, companies can attract customers with aggressive price cuts. So for example, this is more common in industries that sells commoditized products. For example, telco. I'm sure over the recent years, you can see Giga, Gomo, they are all coming up with low price point mobile plans, and it's a steep cut in terms of pricing over the years. On the other hand, where competitive rivalry is minimal, so competitors can focus more on product differentiation rather than price war. So this is where you could potentially have tremendous strength and healthy profits. So this is the case for industries with distinct brands, for example, smartphones. Some people just like to stick with Apple. Doesn't matter what the price is, just because they are so grown to like the product, etc. Secondly, power of suppliers. Basically, over here, you think of how easy it is for your suppliers to increase their prices. How many potential suppliers do you have? How unique is their product or services that they provide, etc. So the more suppliers you get to choose from, the easier it will be to switch to a cheaper alternative. So for example, if you want to start a business in the restaurant sector, you can basically buy your veggie or meat from anyone. So but meanwhile, if you are in the business of manufacturing an airplane, then you have rather limited options because you have to pick the best engines, best safety options out there, etc. After that, we have power of buyers. Basically, how easy is it for buyers to drive your prices down? Are you dealing with a few customers that buy bulk orders from you, or are you just dealing with small customers, etc. So this really determines the power of a buyer. After that, we have this threat of substitution. Basically, the likelihood of your customers finding a different way of doing what you do. So, for example, if Microsoft Office, for example, everyone would be using this because it's a unique software product that everyone just find it so common and it's hard to get a replacement. Meanwhile, others, for example, when you're going out to buy a cup, there are so many different designs out there. So, I mean, yeah. Lastly, we have the threat of new entry, which is basically how your position can be affected by people's ability to enter your market. So you think of how easy can this be done? Is it easy to get a foothold in an industry, etc.? How much would it cost, and how tightly is your sector regulated, etc.? The second concept that I would like to highlight is really the industry life cycle, which is quite simple. It depicts where the various stages where business operate progress and decline over the years. This is very important because where the industry belongs to plays a huge part on how to analyze the companies in it. And also the expectation on valuation will also be quite different. So example, at the initial phase of startup, this is where consumer demand is more limited due to unfamiliarity with the product features and performance. Distribution channels are underdeveloped. So companies or industries at this stage are likely to generate quite limited revenue. And due to the limited economies of scale, would most likely see a negative cash flow and profits. But there aren't a lot of companies at this stage which are publicly listed on a standalone basis anyway. Most of them would still be private or just a small part of a listed company. So if you have to raise an example, this would probably be the ride-hailing industry back in 2016, 2017. Basically, the concept was very new. That Uber and Grab were crazily subsidizing prices to users. and providing incentives for the drivers just to educate the market, etc. Next will be the growth stage. As the name suggests, this is where products or services become more mature. Your revenues start to rise, and after that, profitability would follow as well. I would say a lot of the internet companies are currently in different parts of this phase. For example, in Singapore, let's say, mobile wallets are probably in the more early growth stage because it's still very fragmented. You have, Singtel Dash, PayLah, GrabPay, etc. Meanwhile, if you talk about e-commerce in Southeast Asia, this would be probably at a more later part of the growth phase. Given the currently low e-commerce penetration in Southeast Asia and rapid digitalization due to COVID-19, the industry is still on a very strong growth trajectory in recent years. And while basically number of players have shrank compared to a few years ago, market share is still kind of fragmented, especially in Indonesia, where there are still 5 to 6 sizable players over there. So companies at this growth stage typically enjoy higher valuation multiples, especially if they have a proven track record of superior market share growth versus peers. Next, we have maturity stage. This is when majority of the companies in the industry are well established, and industry growth slows down as it reaches a saturation point. Products are commonplace and popular among public now, and demand is likely to stay fairly high and consistent. So at this point, market share movement would be rather gradual over time, unless players suddenly come out with a very brilliant new market strategy, or maybe competitors screwed up. Product pricing will also be quite stable. So at this stage, when you analyze companies in this stage, basically the key is really what are their strategies? Are they looking? How are they looking to maintain or even grow their market share? How are they maximizing their profits, either through cost efficiencies or etc., or even how do they look for the next phase of growth, either through geographical expansion, through product upgrades, etc., or even M&As. Lastly would be the decline stage. Over here, intensity of competition depends on a few factors. For example, how quickly is the industry declining? What's the exit barriers like, and the level of fixed costs. So companies here might choose to either streamline their product offerings by focusing on the most profitable products, or some might try to acquire smaller players to be the dominant player, while some will just exit. It is typically easiest, I guess, if you're investing, to just avoid such industries unless you're confident of the management's quality. Either that or the cash flow generation is just so strong that you can enjoy superior dividend yield over the next few years. After these two main concepts, basically there are just some other considerations that you could also think about. For example, is the industry a defensive one or a cyclical one, which is dependent on economic cycle? Secondly, demographic influence. Is this industry probably enjoying from the aging population, or is it I don't know, suffering from a lower birth rate over the years? Third would be government and regulatory influences. For example, in Singapore property sector, government can adjust property policies from time to time to ensure that housing prices are always affordable to people. So this part is quite important. Technological influences, basically, do you see the industry that you're investing in potentially being disrupted by new tech players? For example, e-commerce came in to disrupt offline retail, ride-hailing came in to disrupt taxi industry, etc. Lastly would be social influence, which is kind of broad. I guess, for example, COVID-19, is there going to be a long-lasting impact from this pandemic? For example, more prevalent work from home or even hybrid working arrangements. What are the industries that are likely to benefit or suffer? So these are all the things that you should think about when you're analyzing an industry. I have here a case study but I wouldn't really run through it. I'll just show you the slides. This is an example of how you can analyze industries, for example, pharma or even a candy business. Yeah. Okay. So I guess that's about it for my presentation. We can now move on to Q&A.
Thanks, Casey. Thanks for your sharing. I have a personal question with regards to C Limited. Okay, as you all of us are aware, right? C is actually quite popular among the young millennials. I myself is actually looking at C itself. So I understand that their C money is actually up and coming. So I'm not sure. Do you have any thoughts about C Limited itself?
Yeah, so C Limited basically has three main business segments, right? Number one is a gaming business. Secondly is e-commerce, which is, I'm sure, very popular in Singapore. Everyone knows about the Shopee brand. And lastly,
Correct.
C Money, which is still quite an early phase of growth. I don't think it's very common in Singapore. It's actually bigger in Indo. But I think it will start to be more common to see Shopee Pay around because they are starting to, put out some of the, they are starting to accept some of the payments here on offline stores. So I do like C Limited. I think first of all, the most important business is the e-commerce. If you think about, just Southeast Asia in general, how much money are people putting online? Spending to buy things online compared to mature markets like US or even in China, where e-commerce penetration is very huge. So there's a large and very rapidly growing total addressable market, which is a concept that Tim highlighted just now. So not only that, Shopee has a very strong market share in Southeast Asia. I think across the 8 Southeast Asia countries that it has presence in, is the market leader in 7 of it. And in Indonesia, it's neck to neck with the industry leader called Tokopedia. So just from e-commerce point of view, this case study, I think there's a huge runway for growth. So I'm quite positive on the stock.
Thank you, Casey. Tim, do you have any thoughts on C itself?
Yeah, everything, like I agree with Casey. The penetration in Southeast Asia is really low for e-commerce, and so that's one of their key businesses. But relating back to what I'd said about optionality, I think C has really great optionality as well. They have a really good sort of hit game called Free Fire, which is caught fire in South America, in Latin America, where it's become really popular. So there's talk about them also setting up shop and doing e-commerce in Latin America as well, but obviously they'll come up against Amazon and Mercado Libre there, so that's going to be tough. But it looks like there's that optionality for C to actually expand outside Southeast Asia, whether that's in e-commerce or gaming. And it's also, I think with China's clamp down on tech and the gaming sort of clamp down as well, a lot of the games that they have, they're actually getting through Tencent in terms of like right of first refusal. So some of the games that they've done, it's been popular in places like India, where now, obviously China tech is toxic in India, right? So now you're getting games that are coming out of Southeast Asia, and C is a beneficiary of that. So I really like the company. It's got a lot of optionality, and I think as Casey said, there's a massive runway for growth. Yeah.
Okay, thanks, Tim. Shall we take a look at the questions that we have for tonight? Okay, so how do I find the investment mode of a company? Do I read the 10K or create an opinion for myself? Tim or Casey?
I can say this first. I think it's important to obviously go through the 10K and just understand the company and what's going on and how it's positioned. But I think you do have to delve further into the competitive landscape of the industry and the sector, the key players. You know, does it have a defendable moat? You know, is it something where it's a service that will be commoditized, like ride hailing, like what you know Casey's alluded to? You're looking at an Uber and a Lyft, and is it something that people really want to you know, pay extra money for? Is it something they're going to be loyal to, and is it sticky? That's something that's key, right? Because if there's another ride hailer, just like in Singapore between Gojek and Grab, we don't have you know, a preference as long as something is cheaper than the other, unless there's an ecosystem built around it, right? So there needs to be something that's keeping you within that ecosystem, and there needs to be a moat there for the company to defend. But I think it's really important to just look at the trends over quarters, not focus just on 1 or 2 quarters, but look at it over a few years. If the growth story is playing out as you expected, and it's doing well, and it's, you know, beating out competition, and it's, I think usually first mover advantage is one of the keys, especially in tech, you know, and founder led, I think is another thing that I tend to look for in companies in the tech space, is because they obviously have skin in the game, and they've founded the company from a young age, and then they brought it to market, and then they obviously will want to see it succeed. So you're not just getting some executive, you know, sort of parachuted in to run the company, but it's someone who's really invested in the company as well. But there are so many things that you do need to research and do need to dive into much beyond just the 10K. Yeah, that's what I'd say.
Yeah, I agree. I think reading what the company publishes, either in the annual report or prospectus, is a good start. But to really understand the business, you really need to do a lot more homework. If it's a consumer-facing product, it's typically easier. So, for example, food delivery in Singapore, there are a few brands. You can, you know, personally go and try out the products. How long does it take for the products to be delivered to you? How's your customer experience is like? You can do a brief survey among your friends. Or do you like this brand? Do you like that brand? Which one do you like more? And typically you do that not just once, but also over time. And then you see how, you know, the performance or the brand of the product, you know, changes over time. And after, you know, a brief period of observation, probably 1-2 months, then you can really understand, you know, the real differences in terms of what people think, not just from the company's point of view. I think that's a good start, especially to consumer facing products.
Okay. Thanks, Casey. Let's take a look at the second question. My stop loss is frequently hit at 5-8%. What is a good percentage?
Okay. Okay. I mean, I don't do stop loss personally. I don't tend to do that, because I'm like much more of a buy and hold, and when I buy a stock, I have like a really high conviction on the stock, so I don't cut if it goes down like 5-10%. I guess the only time I cut is if I really think the investment thesis has changed like irreparably, and I can't, you know, I don't want to be invested in this company anymore. So from a stop loss perspective, I honestly can't give you an opinion, like an educated opinion on that, because I think it's quite personal. So I'll hand that to Casey if he has thoughts on it.
I think stop loss is more for people who trade using technical analysis. Using fundamental analysis, typically, I mean, it also depends on, you know, how long the duration is before you get that 5-8% loss. What I would do if, you know, let's say my portfolio is in the red, is why did I decide to buy this stock in the first place? Normally, I would have at least 2 to 3 main reasons why I like the stock, and which is why I invested in it. So when, you know, my stock is, let's say, down 10% or 15%, then I'll rethink through what caused me to buy the stock in the first place. These are the 3 reasons that I bought, and are these 3 reasons still valid? If it's still valid, then I'll just hold on to it, or even you know, top up on it. If, you know, there are some recent news flows that caused me to be a bit shaky on one of the reasons that I chose to buy, then that is when I would review, should I maybe, you know, cut loss a bit, or etc. So Yeah, it really depends on your style of investment. For me, let's say from a fundamental point of view, yeah, this is what I would do.
Okay, so both of you won't be sharing on if there's a rule of thumb or any percentage that you guys will actually do a stop loss or cut loss. Am I right? Because for myself, right, I do investing, but I'm not of a trader kind of person. I do long-term investing. So once I actually buy a stock, right, I'll just leave it and I will just not look at it. Because sometimes the market is very volatile, where you can see stock prices actually go up and down very frequently. So it might cause higher tax. I hope they don't feel that, but um I am not sure because some of us actually do feel that maybe if for instance, right, the share price actually dropped by say 5-10%, should I be closing my position, or should I just continue? It's still based on what you have actually shared, right? Like whether do I see like if there's any potential in the company itself, or do I still believe whether this business is actually will have the potential in the near future. Am I right?
Yeah, yeah. I mean, I think like it's quite natural to be scared when things go down. I mean, you know, the loss aversion is real, right? The fear of loss, because losing money is 2 or 3 times more painful than winning money or gaining money. So when we're portfolios in the green and it's doing really well, it's good. But then if it goes into the red, it's like twice as painful in terms of the level of emotion, right? So that's been proven in studies. So it's like definitely real for human emotion that you just don't like to see that go down. But as I said, it's not really a reflection of business all the time. Share prices, they don't always reflect the business. So last year, everything crashed, right? But obviously businesses survived and there were lots of good businesses in there. And so the same thing happened in 2017, 18, or whenever like there was a crash in the end of 2018. And things were fine. So I think it just depends on your, I guess, ability to ride through those troughs. Yeah. But if you're thinking like 5, 10 years, 20 years, like it's really like falling 5-10% is not going to be anything. If you are thinking about companies like Apple or Amazon, which are returning like 10, 15,000, 20,000% over 20 years, right? It's not going to be anything. 5-10%. It wouldn't be much. As I like to say, like the most you can lose is 100%, right? On a stock, when you invest, the most you can lose is 100%. And how often does that happen? And then how often does it happen that stocks go up like 500, 1,000%, 5,000%, 10,000%? So that happens not in like a year. That happens like over 10 years or 15 years. But your limit is like there's no limit potentially. There's no ceiling to it if you're thinking of like a Tesla or an Apple. But you could potentially lose 100%, but that's horrible. But the upside is way, way, way better. So that's how I like to think about it.
I think share price is basically valuation multiplied by, let's say if you use PE, right? PE multiplied by earnings, or price to sales multiplied by sales when you look at a share price. So depending on which industry you're looking at. So of course, the first part, valuation multiple, is very dependent on the sentiment, whereas the other part is all about core business. So if you think the core business is growing, I mean, even if a business is healthily growing 30-40% a year, sentiments change because, for example, last year at the beginning everyone was scared, then after that everyone just jumped into the tech cycle because you're just thinking, rapid digitalization of the world because of COVID-19. So sentiment improved dramatically, which is why share price went up so drastically. Of course, there will be times where sentiment change. So you just have to be mindful of that. So I think it also depends, when you want to decide whether or not to stop loss. Depends on what industry you invest in. For example, tech could be more volatile. You can easily see, share prices go down 30% over 1 month, even though the fundamentals are still perfectly fine. Whereas on a traditional business, sometimes 10-15%, you should already have this. That you should already feel the urge to go and relook at your stock to see, is everything still going all right? Is the company's earnings still on the right track? So I think it really depends on what industry you're looking at also.
Thank you, Casey.
Yeah.
Do we have any more questions coming in? Companies' prices are volatile before the earnings. Is it to go out or and come back in again?
Well, again, that's like trading in and out, right? So I think for earnings, I mean, most places, especially in the US, if companies are reporting, they either report before the open or they report after the close. So they don't report during trading hours, or they report like after hours, right? Or pre-trading hours. So liquidity is really low, and you have to go in and get it, and then you have to be willing to buy after hours maybe in response, and you're probably gonna have to be sort of placing orders and trying to get in there. And so there's a lot of headaches and a lot of stress, and you're probably going to miss out because you're going to be buying off like in pre or after market trading hours, so you're not going to get the best prices. So that's something I think a lot of us miss, is actually most of the price action on stocks like post earnings is not in normal trading hours. So if you just held your stock, or you had bought it and then held it for however many quarters, and the stock did really great because earnings were so great, you would be much better off just holding that stock and not trying to jump in and out. Because jumping in and out, I think this is something that was interesting, that, Howard Marks, his son spent time with him during the pandemic. So Howard Marks is obviously a very, very well-known investor. And he was talking to his son, who is Andrew Marks, who's more of a tech-oriented investor, right? And they were talking about, Howard Marks is talking about valuations, and you should get out of this stock because it's gone up this percentage or this amount of percent, right? And isn't it better to rotate out of that stock and then find another stock? Sort of like the cigar butt type of investing that Warren Buffett sort of proposed, right, as a proponent of. But how many times do you have to get that right to get in and then to get out? You have to get that right every time you do it, right? And how many times are you going to do that? Are you going to do that like 1,000 times, trading in and out? So to be able to get that right every single time, to buy at the right time and then to sell at the right time, is literally like, there are not many people in the world that can do that, But I mean, there are traders who do that a lot, but they're like 0.001% of, people who do trade. So it's something I think a lot of us don't really think about. So it's more about just buying a really good company and just letting it run and letting it ride, right? So for me, I just enjoy looking at aftermarket hours. If I'm holding that stock and it's like crushed earnings, it's great. Like I don't really have to really stress because the stock price is going up, and I'm not that bothered about getting out or getting in, to be honest. Yeah, because it's done well. So I guess short answer is like, there's not much point because you're not going to get good prices. You're probably going to get it wrong like 50% of the time. So I don't know how much that would help, to be honest. Yeah, I think most of the price action's out of trading hours anyway.
Okay. Can I look at the questions again? Sorry. Volatile before the earnings. I guess, okay, for Singapore, let's say result season is coming, I guess, end of this month or even early next month. So there are some people who, trade before, trade in the view that, this company is going to beat results expectations in the upcoming result season, or just sell the stock because they are expecting the stock to probably underperform expectations in the upcoming result season. So, I mean, you can what you can do is just think about the stocks that you have bought. What has happened over the past 3 months, right? So if your stock is, let's say, you buy it because of a recovery play, but over the past 3 months, what has happened? Delta variant has caused a very huge spike in COVID cases across the Southeast Asia region. So if you're talking about if you're buying a stock that is probably, I don't know, retail or travel related stocks, for example, your expectation of recovery would be now compared to 3 months ago would be quite different. So chances are, I mean, you also think that results might be a bit weak in the upcoming result season. So in that case, then yeah, this will be probably one of the reasons why share price is underperforming right now. Then you can adjust your trading strategy accordingly. Should I sell now and buy later after the result season, because share price could potentially go down because of results underperforming expectation, etc. Yeah.
Okay, I think we have quite a number of questions left, but I think we'll just pick one more to go to answer it live. The rest will just reply them directly. Would that be all right? The Little Book That Beats the Market by Joel Greenberg has a magic formula system that is interesting for someone like me who is new to stock investing. Maybe the panelists can share their view in that strategy. Casey or Tim?
I actually haven't read this book, sorry. So I don't really know what's the magic formula.
Yeah,
It
I've
sounds
not
like
read
a
that.
quiz.
I've not
Any
read.
of you?
I've not read Joel Greenblatt's that book. No, I've not read that either.
No.
Magic Formula.
Oh,
But
no.
I would say, yeah, I don't know like what the framework is, but obviously I think it's good to read as much as you can, like in terms of when you are starting out, just reading different sources and understanding a style that fits you, because everybody is different. So I think there's no right or wrong way to analyze and to pick a stock that you like. It's like dependent on your personal sort of risk as well. So yeah, I mean, I guess myself and Casey aren't qualified to answer because we've not read that book. So, but so I would say just read as much as you can and just learn as much as you can from different sources. Yeah.
Make sure you understand what's the concept behind and apply it accordingly. So because everyone has very different investment horizons. Some people just like to do day trading. Some people do 1 or 2 months. Some people hold 1-2 years. Well, some people just like to hold on for like 10-20 years. So different investment strategy applies to different holding period. So of course, me as a sell side research analyst, I always look out for what's going to happen in the next 3 months to 1 year. Whereas Tim, when he writes, all his investment articles, he might be holding a longer term view. So, I mean, there are different strategies that can work. So it's very important to understand why people recommend this strategy. How does it apply to different investment horizon and apply it accordingly?
Yeah, definitely.
Okay.
Yeah,
Thank
you cannot just
Casey.
use someone's method for 1-2 year holding and then buy it 1 month later you regret, etc. So it's quite different.
Thanks, Casey. Thanks, Tim.
Yeah.
Thank you so much. Thank you all of us for joining to tonight's session. But before you go, we'll actually like you to actually participate in our little survey to help us improve on, say, maybe what are the topics that you would actually like us to feature in our upcoming webinars. Thank you so much and have a good evening.
Thanks, everybody.
Thank you.
Bye.
Thank you. Bye.